Okay, well, it's a pleasure to be back in Melbourne talking with everyone. Mike touched on some things. I have an entire lecture on the relevance of academic research for policy that I've given several times. And it is true, it's hard to convince people that what we do as academics actually is how we think about policy. Without it, you don't have any kind of framework for thinking about problems. But today, I'm going to talk about what policymakers talk about. So it's kind of a boring title. And of course, I have to say this. And the views I express today are my own and do not necessarily reflect the positions of the Federal Reserve Bank of St. Louis or the Federal Reserve System, even if they should. Okay. So I'm going to talk about these kind of key themes that everybody's talking about in the U.S. or at least on the policy side. Some of these things may not be familiar for Aussies, so I'll try to explain things wherever I think it's important. But the first thing is within the Fed, where I work, we have a new Fed chair and a very changing structure in leadership that's going to be important to think about going forward. The big thing at the Fed is we have this very large balance sheet, and we've been talking about unwinding it or shrinking it for a number of years, so I'll talk a little bit about that. That seems to be going well. Big thing is tax reform on the U.S. side. We had a huge rewrite of the corporate and individual tax code that we're kind of waiting to see what will happen. And then I'll talk a bit about a little financy stuff, which is the yield curve, which for a while was creating a bunch of problems, but it says something about interest rates going forward. All right. So one of the things as a central bank is you have certain goals you're trying to hit for the macroeconomy. And as of right now, we are about as close to hitting all of those goals as we possibly can. Okay? I'll talk about the balance sheet a little bit going forward. But as we start to shrink our balance sheet, basically what it means is we're not going to buy a lot of long-term U.S. treasuries. So the demand is going to fall. That's going to drop the price of these assets and push up their yields. Tax reform is going to have a similar effect on long-term rates through its effect on the deficit. And that this, with some recent news on inflation, is also going to have some effect on pushing up yields. So what's the punchline of this? All three of these things are going to lead to rising interest rates. That's the takeaway, at least in the U.S. All right, let me just talk about the Fed. So we have a new chairman, Jay Powell. He was recently sworn in to replace Janet Yellen, who was the first woman chair of the Fed. Despite being an Obama appointee, the rumors were that President Trump actually wanted to reappoint her, but all of the Republicans in the White House said you can't possibly do that. So he really liked her and wanted to keep her, but they said no. Now, I've worked with Jay for about 5 years as governor. I go to all the FOMC, Federal Open Market Committees, where the Federal Reserve sets interest rate policy, and I've gotten to know Jay a lot. I think he's actually a very good choice, very smart, he's very calm. He's not a PhD by training, but he kind of absorbs economics faster than any non-economist I've ever seen. So that's one of the things people have speculated, and that has led to a lot of debate about will other FOMC members have influence on the chair? More importantly, will the staff of PhD economists have more influence now by having a chair that's not an economist? All right, so this is just kind of a card. Now, the one thing I'll mention, the way the Board of Governors is set up in Washington, D.C., is the governors serve 14-year terms, and they overlap 2 years. So since the U.S. president can only serve 8 years, this design is that you could never appoint more than 4 of the 7 members. But no one serves 14-year terms anymore. So you have a lot of resignations, and right now, Governor Brainerd is the only governor that was appointed by the previous administration. So what's potentially going to happen here, and that's all I've got this slide, is for the first time in U.S. history, one president is going to be able to appoint every single governor of the Federal Reserve. Okay, so that's all we're doing here. Jay took Janet's place. Randy Quarles was put in as The vice chair of supervision, Lael Brainerd, is rumored to be headed out the door. Powell left, of course. Hasn't been replaced. Marvin Goodfriend, who's an economist at Carnegie Mellon in the U.S., has been nominated. His appointment is looking kind of bad. It's not clear he's going to make it through. And then we have to have a community banker. It's a woman who is a banking regulator from Kansas. Then there's one open seat, which we don't know who's going to be picked. Bill Dudley, who's head of the New York Fed and is the vice chair of the FOMC, is retiring in June. We'll have another pick. So what you're seeing here is there's going to be a lot of turnover. That always generates a lot of uncertainty about what may happen in terms of Fed policy. Myself, I'm not as concerned about it because some of these presidents down here, although they're fairly new, Barkin and Bostic have only been in the job about a year or less. They're going to be voting members, but that means there's at least a core of presidents, including my boss, who's now been in the job 10 years, who kind of provide an anchor for how to think about going forward on policy. So this is and the reason I'm spending time, this is an unprecedented moment in Fed history to have this much leadership turnover. And given the current president, it wasn't clear exactly how this was all going to play out. Oh, there we go. Did I go too far? No. All right. So what do we think the FOMC is looking, this was the whole idea of a near-term outlook. What do they think they're going to be doing on interest rates? So 4 times a year, all the members of the FOMC, the 7 governors and the 12 presidents of the banks, that's the total FOMC when it's fully operational. They're asked 4 times a year, tell us where you think interest rates are going in 27, this was in December, 2017, 18, 19, and 20, and then in the long run. And so one of the things you can see is all of the governors, all the members of the FOMC see rates rising for the next 2 to 3 years. Okay, and in the long run, it's going to settle down somewhere around 2.75 to 3%. So that's where they think rates are going to settle down in about 3 or 4 years. There's this line of blue dots way down here that don't go anywhere. That's us in St. Louis. Okay? And the idea is we don't think there's really any reason to be raising rates. And I'll sort of talk about that here in a second. So that's why I pointed out. We have a very different view in St. Louis about what the rate path should be compared to everybody else. All right, and here's partly why. If we look at our goals of full employment, stable prices, financial stability, when we look out of the world, and if you were to take say a quadratic loss function and say, here's your target, here's where you are, how far, what's the loss? You can see we're about as close to our goals as we've ever been in the history of the Fed in the last 65 years. Okay? So if you're hitting full employment, inflation's on just a little low, and there doesn't seem to be any big financial sector things, why are you raising rates? Why are you raising rates? That's the puzzle we have in St. Louis. Everybody wants to raise rates. Why? Do you see inflation? No. Do you see overheating economy? No. Do you see a lot of financial excess? No. Then why are we raising rates? Okay, so that's kind of our view in St. Louis is we don't see any reason to be raising rates, certainly not almost 200 basis points in the next 2 to 3 years. Because if I showed you the plots of inflation, unemployment, everybody is at the long run right now, pretty much. So it's like, why are you raising rates? It's just not obvious that there's some problems. I think a large part of it seems to be driven by the idea of we want to get back to normal, and these low interest rates are not somehow normal. Well, that's not our job. Our job is to hit these targets, okay? And we're doing a very good job of doing that. All right, one of the things I thought this was a fascinating slide. This is the beauty of having really good RAs. I gave a talk last summer in Cartagena, Colombia, at a meeting of South American central bankers. And my talk was on central bank communication and the importance of central bank communication. And so my RA had pulled this up. And it's like, one of the things you can see here is when we communicate policy, are the markets in line with what we're thinking? Are we communicating policy in a way that the markets understand it and are reacting that way? So all this thing is trying to show you is from the market prices of what are called Fed funds futures, you can back out the probability of a rate hike just through a simple pricing equation. And what you can see is in the last couple of years, we've had a tremendous success at when we've done rate hikes that the market believed they were coming. These were not surprises. These were not shocks. These were kind of telegraphed, and the market believed them, and then we carried through on it. So that doesn't happen a lot of other times, okay? So these were periods where we didn't raise rates at all. So that's why there's no black lines. We did not raise rates from here on until here. Yet the market was always constantly believing we were going to raise rates, and we never did. So that's, why do I care about that? It says something about our credibility. We're either not communicating well, or we have no credibility in terms of what we think we say we're going to do. But that seems to have gotten a lot better in the last few years. And I give credit to Janet for this. Janet was very good at trying to be very clear, very deterministic, not kind of guessing what may or may not happen. All right, so here's one of the things. We have a president and administration who's pushing for an agenda to generate growth of 3%. We've been kind of in this 2% to 2.2% growth rate of GDP, or the growth of the economy, for the last 10 years. The administration wants to take a bunch of policies and try to get that back to 3, which is more of a long-run trend. So what are we looking at? 2017 pretty much came in at about 2.5%. Pretty much what everybody expected, no surprises. We passed this big tax bill. Is it causing expectations of growth to rise? Well, this is what we've seen, and the reason I just threw this up there, this has been a very contentious problem for the Federal Reserve for a number of years, is when we look at GDP growth data, one of the things the data agencies, we don't create the data ourselves, we just take the data, is they take out what are called seasonals. So for example, here's the easiest thing to think of as a seasonal. Every December, employment shoots way up, and every January, it crashes. Why? Christmas. So what do? You kind of want the data to smooth through these things that happen on a regular seasonal basis, okay? So when you take out seasonals, these numbers should all be kind of roughly the same. But you notice the first quarter always seems to be low. So for the last, almost as long as I've been at the Fed, we get pretty decent numbers in the third and fourth quarter, and the first quarter crashes. So there's been a debate for a couple of years that this is some statistical problem. The seasonality is not being done right. We can't pay attention to these first quarter numbers very carefully because they never seem to be right, because then the second quarter always is much higher, okay, than the third and the fourth quarter. So there's something weird going on in the data we have to be careful of, okay? So right now everybody's projecting about 2.5% growth for the first quarter. If you take the last decade or so, the bets are it probably isn't going to come in at 2.5. Now, this is exactly what we are. We're sitting here among all of our other banks, our colleagues, and we run what are called nowcasts. So those of you who do econometrics are probably aware of this, but if you're not, what you try to do with a nowcast is you take daily data as it rolls in. And based on that daily data, you kind of say, what do we think is going to happen to GDP? So this is all kinds of different data, but it all has some impact on the economy. So Atlanta Fed runs one, we run a couple, the New York Fed does, and then these are, Blue Chip is a business sector economist, and Macro Advisors is a forecasting firm. And you can see that most of us are predicting first quarter GDP at running closer to 3 to 3.5. A lot of this is driven by business confidence, investment, manufacturing surveys, stuff like this. So this looks pretty good, but we'll have to wait and see because we've had this seasonal residuality problem in the past. All right, balance sheet normalization. All right, for people who don't know, when the Great Recession hit, the financial crisis, the Fed, in response to try to keep the economy and the housing market afloat, set off, drove interest rates to zero, and then once you get to zero, central banks are kind of out of ammunition. And the answer was no, the short-term rate is at zero, we can do things to push down longer-term rates. So we undertook what was called quantitative easing, although Chairman Bernanke hated that phrase. He liked to call them LSAPs, large-scale asset purchases, but everybody calls them QE, and I will too. So QE1, we went out and we bought 1.75 trillion, that was a word I had to get used to as a policymaker, trillion dollars worth of mortgage-backed securities and U.S. Treasuries. And then in QE2, we did it again. We bought 600 billion. And then we embarked in QE3, which had no endpoint. And by the time we were done, our balance sheet went from $800 billion in 2008 to $4.5 trillion about a year ago. So we bought somewhere in the neighborhood of $3.7 trillion worth of assets. Now I like to point out, if you want a measure of how big that is, if we'd gone out and bought equities, we would own the 7 largest corporations in the US. Apple, they're ours. Exxon, they're ours. Ford, they belong to us. So that gives you a sense of the scale of what we bought. Now, we did that to try to help the economy, not because we thought, hey, this is great. So we did it, but we always did it under the promise that we would eventually unload this stuff. It was never intended to be a permanent part of our balance sheet. We did it for emergency purposes. The emergency seemed to last a lot longer than we thought it was going to be. And so finally we decided in December of 2016 to start talking about this, getting the markets ready. This is back to the communication thing. We had to start getting the markets ready for the day when we would stop reinvesting, or we'd already stopped buying, but whenever these assets matured and we had to get paid off, we'd go back and buy a new one. So if you had a 1-year treasury and the treasury had to be paid, we'd turn over the treasury, they'd give us the money, we'd just go back and buy another. That's what the reinvestment policy was. We would just reinvest on any maturing assets. So we learned a valuable communication lesson in 2013. In 2013, Chairman Bernanke kind of came to the view that, look, we got to start talking about ending QE3. Okay, it's been on long enough. We got to start slowing it down. Not ending it, but just slowing down the pace of purchases. He talked about this in Congress in the middle of May, or May 22nd, and 3 weeks later, he announced we're doing it. So how much preparation for the markets? Zero. And there was this thing called the taper tantrum. Global markets had a fit. 10-year treasury jumped up about 50 basis points, which in this market, that's an earthquake of a move in interest rates. I mean, this is shocking. And it was all because we hadn't kind of prepared the markets for this. So fearing another taper tantrum when we were going to start letting our balance sheet shrink, we went through a lot of effort for 6 months, warning the markets, get ready. We're going to start letting this stuff run off. We're not going to sell anything, but we're going to let it run off. But we're going to let it run off in a very controlled pace. Okay, we're not just going to open the dam and let the lake drain. Okay, we're going to let it slowly come off. We did that, and then we laid out a very clear plan when we finally started it, which I think is the next slide. What we basically said is, look, we're just going to sell up to 6 billion treasuries a month and 4 billion of mortgage-backed securities, so about 10 billion a month. That's all we're going to let run off. Anything over that, we'll reinvest, and then we're going to slowly run this stuff down over a number of years. We announced this, we started it, the markets went, perfect, right? We wanted this to be, as President Harker in Philadelphia said, we wanted this to be as exciting as watching paint dry, okay? And we succeeded. Now, the other thing, if you look at this, you're not running much off. On a $4.5 trillion balance sheet, you're running off $120 billion a year. That's nothing. If you're thinking of shrinking $2 trillion off your balance sheet, this is going to be a long process. So even though we've started the normalization, it potentially is still going to be a number of years before our balance sheet shrinks. We've also said we're not selling assets. And because the MBS are mortgage-backed with 30-year mortgages, they're going to roll off much slower. So treasuries will run off faster than the mortgage-backed securities. So we're still going to be holding a lot of mortgage-backed securities, which I think many people are uncomfortable with. All right. So one of the things that has happened, if you look at U.S. yields on the 10-year Treasury, which is a benchmark interest rate in the world, that's been incredibly low for the last 10 years. Okay, so now when interest rates are low, it means the prices are high. People are willing to pay a lot for these assets. And so the question is, why is this asset in such high demand in the world? Okay, so there's been a huge demand for these for a number of reasons. Safety, central banks have built up large reserve positions to defend their exchange rates if they need be. They learned this in the late 90s. Okay. Regulatory demands have pushed up the need for firms to hold U.S. Treasuries as safe liquid assets. Those of you in the banking industry may be aware there's a liquidity coverage ratio that now banks have to meet. And so that means basically holding for the U.S. banks, a lot of U.S. Treasuries. So all of these things and an aging worldwide population led to sort of demand for safe assets, and the U.S. Treasury was a safe asset. We are starting to think that some of that's all now going to unwind. So first of all, we're not buying anymore. Okay, we're not buying them. We're trying to roll them off, so the demand is not there from the Federal Reserve. The tax law that we just passed is going to increase the supply of this debt. By Congress's estimates, this is going to add, the tax bill that I'll talk about shortly, is going to add $1.5 trillion to the U.S. national debt over 10 years. They're way ahead because right now the estimates are they're going to add $1 trillion just this year. Okay, because the growth hasn't picked up to the point that people thought, and there's some other things going on. So instead of issuing maybe $500 billion of new debt, it's looking like $900 billion going forward. So there's going to be a big supply of debt on the market. The ECB has started exiting its QE plan. Okay. So what happened was when the ECB was driving interest rates negative, everybody was fleeing to U.S. Treasuries and away from European debt. As you unwind the European QE, there'll be an outflow back to European government debt. And then recently, China has given some indications that they are not going to expand their holdings of debt anymore and may actually shrink it. We've seen some estimates that through a bunch of backdoor channels, they may have actually already unloaded about $300 billion out of their $2 trillion holdings. Okay? So all these things are going to tend to push treasury prices down and push the yields up. That's just talking about the supply. I just said it, so no point going through it. All right, tax reform. One of the big debates or things people want to talk about. So in 2017, President Trump signed into law the Tax Cuts and Jobs Act, which is always kind of funny because we have 4.1% unemployment. Nobody's arguing that they're having trouble finding jobs, but I guess we felt like we needed to create some more. The thing is true, this is the most sweeping rewrite of the U.S. tax code in over 30-something years, okay? And what it did was it lowered individual tax rates and business tax rate and tried to broaden the tax base. So whenever you're trying to make something semi-neutral, that's what you have to do. You cut the rates, but you have to broaden the base to apply that lower rate to. And that's in part what Congress was trying to do. As I said, they set out that this would add about $1.5 trillion in debt over 10 years. Okay? So that was the only way this was going to get through. Now, obviously, some of this intention is the tax cuts are a form of fiscal stimulus. For consumer, the tax cuts obviously are going to give incentive to work more, consume more, so that should stimulate consumer demand. Reductions in corporate taxes are going to incentivize corporations to invest. Cost of capital is now cheaper. And so all of this should flow flow through the economy, both through consumption and investment. Investment's been one of the weak parts of the U.S. recovery in the last 10 years. All right, now why does corporate taxation matter and how does it affect wages? So first of all, in open economies where you have fairly open borders and capital can go anywhere in the world, which is a fairly accurate description of the world markets now, capital can flee to the lowest tax country. Okay? So by decreasing capital in your home country, and capital and labor are complements in the aggregate, by lowering your capital, you lower the demand for labor. Okay, that's going to suppress wages as well. So this is one of the arguments that were put forward. If you lower the U.S. corporate tax rate, you would make capital more attractive to have in the U.S. If there's more capital, that capital needs workers to work it. And that would raise demand and push up wages. Okay? And employment. So that's the standard economic argument for lower capital taxes or corporate tax rates. Okay? Now, this is from the Joint Committee on Taxation. This is their kind of rough estimate of all the things that were changed, what's going to add revenue and what's going to lose revenue. Okay, so the first thing you see is that the new tax brackets and rates on households is going to cost about $1.2 trillion in lost revenue. Okay, so you lower the tax rates, you raise the base at which the low tax rates apply, that's the impact. So if you're going to try to do something semi-neutral, it's got to come from somewhere else. That's what you see down at the bottom. Okay? So they limited deductions for mortgage interest, state and local taxes. That was a big thing. It mainly hits, politically people would say this hits the blue Democratic states, New York, California, which have high state and local taxes. It also repealed the personal exemption. So what all that means is when you file your tax returns in the U.S., you used to get $4,000 per every member in your family deducted right off the top. So if you had a family of 4, you got to deduct $16,000 right off your taxes. That's gone. So that $16,000 is now back in your taxable income, but they doubled the standard deduction from $12,000 to $24,000. So that's kind of a wash for a lot of lower income households that don't itemize. But you can see just repealing the personal exemption, just getting rid of that one thing, basically offsets all the tax cut stuff. Okay? Now on the corporate side, they reduced the corporate tax rate from 35% to 21%. Now let me just point out, 35% is the statutory rate. Nobody paid that. Okay, this is always one of these misleading things. The statutory rate, no one paid it. In fact, everything I've ever seen was that the average tax rate corporations paid was 20. So all you're doing is basically getting the marginal and the average kind of lined up more accurately. But you can see that it's going to cost about $1.3 trillion in revenue by lowering those rates. But they're broadening the base of things that are being taxed. So one thing is they limited the amount of interest that corporations can deduct off their debt. One argument economists have made for decades that you shouldn't have any advantage of debt over equity. So you should not allow firms to deduct interest as an expense. So they're kind of moving in that direction. They didn't go 100%, but they went that. And then they broadened the tax base to include a bunch of stuff. But you can see that the business tax over the whole life of the bill is going to add about $700 billion in national debt. All right, so these are just larger deficits. So you can already see this 2018 was projected to be about a little over 600. I think, like I said, more recently that number is closer to $1 trillion just for this year. So this could turn out to be a lot more expensive than anybody thought it was going to be. This is the net increase over what was already there based on putting the tax cut in there. Okay, so this is all the addition into the national debt that's coming down the road, meaning more issuance of U.S. government debt. If the demand isn't there, this is going to cause rates to go up, and suddenly the interest cost on servicing the U.S. government debt is going to get a lot higher, which nobody, I think, was quite worrying about. And you can see where a lot of people are saying, The Fed's going to be raising rates, pushing up rates. The Treasury is going to be issuing a lot of debt. Rates are going to go up. Oh my God, we're going to have a lot of interest expense we haven't had for 10 years. All right, so will investment keep pace? Okay. And like I said, one of the surprising things is in the last 10 years, coming out of this recovery, we just haven't seen business fixed investment keep up with the rest of the economy. Most things have kind of come back. Consumer non-durables, services spending, everything else has kind of come back, but business fixed investment and consumer durables haven't quite kept pace. Okay, so the whole idea of a lot of the tax change was to get firms to invest in the United States, in capital, equipment, plants, factories, everything. Okay, so that's kind of the idea here. We put in a tax holiday because there's estimated between $2 and $3 trillion of profits held overseas by U.S. corporations. Now, I'll just make one comment on this, that to avoid the taxes overseas, those profits have to be held in liquid, low interest bearing assets. So you don't pay any taxes, but you got to hold it in a really crappy asset. So this is what the firms don't like. If it was like, you can hold it, just don't bring it back, they would just build factories in China and Australia and South America. Fine, sure, we'll just use it for investment. If they do that, then they have to pay taxes on it at 35%. So these firms have locked up all these profits in these kind of low-bearing interest liquid assets, and they want to unlock them. Okay, so that's kind of the whole idea of then saying, these are past profits, we'll give you this tax holiday. I think it's 14%. You can repatriate all this profits back to the US, pay us 14% of whatever that value is, and then you can unlock these assets and do whatever you want with them. Okay? All right. Now, the other thing here is, the idea is this would all spur a bunch of investment. If rates are going up, that's going to deter investment. So these things may just net out. We may not see a big net effect from all this because other, what we call general equilibrium effects, are causing rates to go up, countering the tax cut. Firms also are potentially going to be reluctant to do anything if they don't think these tax changes would last. Suppose in 4 years, this is a 10-year plan. Suppose in 4 years the Democrats sweep through and take over the U.S. This is not clear this tax plan is going to be in place 6 months later. Okay, so that's, if firms are facing that kind of tax uncertainty, they still may hold off on investment. Okay, but forecasters are optimistic. You can see the gray bars, which are as of February, they've all kind of come up for real fixed investment, corporate profits. So all the forecasters think all these changes will have a positive effect on fixed investment, disposable income, and real GDP. Not quite 3, but getting there. Now, one of the big arguments for repatriating the profits is that if we let these firms bring these profits back home, they got to do something with them. And one of the things they do is invest in new plant and equipment so they don't have to potentially borrow on financial markets. Okay? So that's kind of the idea. Now, we did this in 2004. There was already in 2004 a lot of money being held overseas. And we said, okay, let's bring it back. And they paid the taxes, they brought it back, and what did they do? They gave it back to the shareholders. They didn't do any investment. They just came back, they did stock buybacks, and they had one-time dividend payments. Now, that's fine. What are the shareholders going to do with the revenue? Got to do something with it. So it's just not clear that the firm itself is going to do the investing. It may be spilt over in a much broader, diverse way. The other thing you can do is just pay down your debt. You bring back all the profits, you pay down your debt. Now that would have been optimal if they had gotten rid of completely the interest rate deduction for business expense. Then it would have made sense for firms to bring it back, pay off their debt, because debt no longer had any advantage for them. The other thing people forget is the repatriation just means you pay the taxes. You're free now to put it wherever you want. It doesn't mean it's coming back to the U.S. Now I can go build that plant in Australia. Now I can build the plant in Singapore. Okay, all the paying the taxes is it frees you up to go do something with it without you get to pay a lower tax rate to have the freedom. So again, it's not even clear that they're going to bring this back into the U.S. They just pay the taxes, take it, now let me go build my plant wherever I want to build it. Doesn't mean it's going to be in the U.S. There we go. Now the biggest puzzle as an economist is we like to think of these kind of big tax effects as you do them in a time when the economy is not doing well. This is the whole idea of a stimulus. The economy is kind of struggling. You use fiscal policy to kind of boost the economy and get it going. We're at 4% unemployment. We're at almost lows we haven't seen in just once or twice in the last 50 years. So we already got lots of jobs. In fact, the problem, every time I talk to employers, it's finding workers. It's not that there's a bunch of workers lined up. They can't find the workers they need, okay? So it's kind of a mistimed, like, what are you trying to do? You know, we've got plenty of jobs. I understand the tax code changes you may want to make, but as a fiscal stimulus, it's not obvious why you want to do it, okay? The other thing is you're doing it right when we're raising rates. So it's kind of counterproductive. You're just, again, monetary policy is kind of trying to maybe tighten things up. Fiscal policy is trying to stimulate it. On net, you're kind of at loggerheads and nothing really good comes out of it. All right, the yield curve. This is geeky, financy stuff. I'm sorry for you who are not economists or finance, but I'll talk about it. All right, so let me just say very quickly what the yield curve is. It's just a plot of data. You take the maturity of a bond, 3 months, 6 months, 1 year, 5 year, 10 years, and on the vertical, you just plot the interest rate that thing pays. That's it. There's nothing scientific, it's just a plot of data. Normally, that thing slopes up, meaning the longer the maturity till payoff, the higher the interest rate you have to pay by issuing it. That's all it means. But there's nothing in theory that says it has to be upward sloping. It could be horizontal, it could be downward sloping, and sometimes we see that. So I want to just talk about this a second. We started lifting off interest rates off the zero lower bound in December of 2015. We have now raised rates 125 basis points, or 1.25%. I never talked in basis points until I became a central banker. I always thought it was silly to talk in it. Now I can't think of any other way to talk about it. So what that has done is the 3-month U.S. Treasury bill, the short-term government, that has gone up 1-for-1 with what we've done on the policy rate. But the 10-year yield, up until the last 2 months, didn't hardly move at all. It was 230 basis points when we lifted off, and up until about early December, it was still at about 230 basis points. So what that was saying is short-term rates were rising and long-term rates weren't moving at all. And let me make a comment that all housing mortgages in the U.S. are benchmarked off the 10-year. So mortgage rates weren't moving, housing wasn't being shut down, which is often a channel we think is cut down when we raise rates. So basically what has happened is the yield curve was flattening, okay? Why is that a big deal? Who cares? Well, if you look at the data, every time the yield curve goes from positive to negative, you get a recession, like 8 out of 9 times in the US. Within 6 months of that yield curve inverting, boom, you get a recession. So that's why we're sitting there watching this thing flattening, and it's like, this isn't good. And the question is, why weren't long-term rates going up with the short-term rates? Arbitrage should tell you if short-term rates are expected to rise, the long-term rates should rise with them. They weren't doing it. So what tends to happen? Well, either investors believe real interest rates, which are going to be driven by, say, economic growth and the performance of the economy, productivity in the economy, either those things aren't going up, or you think inflation is going to go down. Both those things happen in recessions. So if long-term rates are below short-term rates, that's just a pessimistic outlook by the markets on the state of the U.S. economy, or any economy. So that leads to people who want to get into the long end of the yield curve, safe assets, and that's it. So that was how we were interpreting things in December, was that this is not a good thing. We don't have a theory for why the inversion causes a recession, but man, is it correlated. I mean, it is an amazing predictor. Just plot, I should have had a plot in here. It's pretty amazing. So, are these concerns abating? And the answer is yes. If you just look at 10-year Treasury yields in the last couple of months, they've gone from 2.3 to 2.9. So they've jumped 60 basis points. And as I tell you, in these markets, these are monumental movements in asset prices. Okay, this isn't like stock markets, which just bounce around all over the place. So our balance sheet normalization is potentially having an effect by raising the term premium. We saw finally, and there's some signs of inflation ticking up. I'll show you some data here very quickly. As we said, the passing of this tax reform is going to blow up the deficits and blow up the amount of debt issuance. That's going to tend to have downward pressure on bond prices. So we think the supply of treasuries is going to kind of start outpacing demand in the coming months and will continue to push rates up. So this was inflation. This is always kind of an amazing thing because as central bankers my whole life, the problem was how to keep inflation down. Now, for the last 5 years, how do we get it to 2%? So this is the consumer price index, and you can see that literally we haven't even been close to 2% for the last 3 years. The red line takes out volatile food and energy, but you can see we're just below 2% for most of my life at the Fed. It's a puzzle. If you'd have told me when I went to the Fed, can central bankers create inflation? I said, it's the only thing we know how to do. It's keeping it down that's the problem. And now it's just the opposite. We can't see. But recently, we've seen an uptick in the CPI. And if you looked at the markets a couple of weeks ago, there was some evidence of some wage pressures. I find this really funny. For the last 2 years, wage growth has been 2.5 to 2.7, 2.8%. And the data came out a couple of weeks ago that it went to 2.9, and the markets had a heart attack. 1/10 of a point. So people were saying, well, inflation's back. Okay, this is actually the price index measure we use at the Fed. This is our actual inflation measure. I mean, again, like I said, you got to go back to, we haven't been above our inflation target for 5 years. Now, one question is, who cares? It's at 1.5. I was telling people at lunch, I have yet, in almost 10 years of being a central banker, had anybody come up to me, why can't you guys get inflation to 2%? This is killing me. This is killing me being at 1.5%. No one seems to really care, so why are we so obsessed as central bankers that we're at 1.5 instead of 2? Okay? But the punchline is it's starting to creep up a little bit. We've been low, we got a little blip up and then it crashed again last year. And it's starting to show some signs of life. So we'll see if that continues. The other thing is long-term inflation expectations. So if you're buying a 10-year treasury, you're worried about long-term inflation. Not current, but long-term. So you can look at what are called treasury inflation-protected securities. Take a 10-year treasury that is protected against inflation and one that's not, and then you can back out what inflation expectations are so that you're indifferent between the two. That's what all these numbers are showing you. So these are constructs, and you can see that inflation expectations were low for most of 17, but now they've popped back up over 2%. So we're starting to see some possible return of inflation, and whenever you have expected inflation, that tends to push up longer-term yields. And this is the rally in the 10-year. Like I said, back to about October, it was right around 2.3, and now it's up at 2.9. That's a huge movement for real interest rates. And this was the yield curve slope when we lifted off. This is what it was in December at the last FOMC meeting of 2017. So you can see it's just flattening out. And then since then, the long end has shifted back up. So What does that mean? People aren't expecting a recession. That's good news. I like that as a central banker. I like a positive outlook in the world. So conclusion, there are several factors that are putting upward pressure on long-term interest rates. Rising inflation, a shrinking Fed balance sheet, larger deficits due to U.S. tax reform. These things are all things that are going to weigh on the FOMC as they move forward through 2018 in terms of how many rate hikes and what pace they want to do it at. And if you look at the SEP, the most recent one, there were 3 hikes projected for 2018 and 2 for 2019. So we're basically going to double interest rates in the next 2 years, less than 2 years. That's the projection from the FOMC members. Whether that happens or not depends on what actually happens in the economy. But that's that path I was showing you going up. And I'll stop there.